This past week, interest rates ticked up to their highest levels so far this year as the minutes from the Fed's last meeting were released. Let's discuss what happened and look out what lies ahead in this week's Mortgage Market Update. Fed Chair Powell emphasized that a rate cut in March was not the Fed's base case, a sentiment echoed by most Fed members as indicated in the minutes. While there's agreement on proceeding cautiously with rate cuts due to inflation being above the target, there's also concern about maintaining rates too high for too long. This mixed messaging underscores the uncertainty surrounding inflation and the economy. The Fed remains data dependent, relying on incoming inflation and economic readings to determine rate cuts. Currently, the market anticipates a rate cut in June, a shift from expectations just over a month ago. So overall, the Fed confirmed what we knew back in January. Rate cuts are off the table for now, and they need to see more disinflation for the Fed to move lower in rates. But there was one note from the meeting that could help long-term rates-like mortgages in the future. They said, noting reductions in overnight reverse repo usage, many officials said it would be appropriate to start in-depth balance sheet reductions at the next meeting. The Fed's balance sheet reduction is another form of tightening monetary policy, and it is a reason why long-term rates, especially mortgages, are higher. If the Fed starts to slow balance sheet reduction, it could lead to stabilization, possibly improvement in long-term rates. Overseas this past week, a poorly received German bond auction caused rates to rise globally, impacting mortgages. Shortly thereafter, our treasuries sold $16 billion worth of 20-year bonds, and that auction also went off poorly, meaning investors needed to be compensated with a higher yield to be enticed to buy the bonds. Now, LEI is BAD. The Conference Board's leading economic indicator report showed the U.S. slowed quickly between December and January, highlighting the uncertainty around the strength of the economy. On one hand, we have a strong labor market, and on the other hand, we see numbers that suggest recession threats are rising. The 10-year Treasury note is now showing a resistance at the 4.32% level, which has prevented yields from rising further recently. This is the new line in the sand we need to be watching. The bottom line, uncertainty persists in financial markets regarding the economy's strength and the timing of rate cuts. This suggests any improvement in long-term rates may be short-lived until clear data emerges. Now, looking ahead, the core personal consumption expenditure index, or PCE, reading this week will be crucial. If it exceeds expectations like the recent CPI and PPI numbers, the bond market may face challenges. Conversely, a below expectations reading could be welcome news, as the core PCE is the Fed's favorite gauge of inflation. Now, as we wrap things up here, here's a peek at current mortgage rates to start the week. Feel free to hit the pause button for details. And as always, thanks for hanging with me for this week's Mortgage Market Update. Be sure to like, comment, and share. I am always here to help, and I look forward to funding your future. Have a great week.